Pass it on this ginger. Pass it.
Hi guys, thank you for joining.
Good. Suresh automatic color. Il va travailler à bon moyen.
É tão caleu, é tão mais quem caleu.
So we're going to be having 3 speakers today. First, we'll be hearing from Mr. Olubumi. Secondly, we'll be hearing from Mr. Adekombi Idowu. And thirdly, we'll be hearing from Mr. Chuks Obiri. Now, these are verified gurus in their field. They're going to be telling us stuff about the financial markets. They're going to be putting us through things that we did not know about before. So I hope for the next 20 minutes, you can get your writing material, your notepad, your iPads, whatever it is, get ready. So Mr. Olubumi will be our first speaker. And for the next 20 minutes, I want you to get ready while he takes us through the Fibonacci Miracle. Mr. Olubumi, are you with us?
I changed the light.
Hello, I'm with you, Chinasa. Thank you for having me.
Okay. So welcome, Mr. Olubumi. Okay, first, before Mr. Bumi starts, I'd like to give a brief intro on who Mr. Bumi. Mr. Bumi is a strategy and tech innovator with more than 8 years of combined experience in ARP consulting and trading. He has experience in strategy. He has experiences in operation, innovation, and technology. Now, currently, he's the head of strategy and operations for IBF Market. So, Mr. Olubumi, the floor is
Only water from your auntie.
Mr. Bumi.
Yeah, with you.
Okay.
All right.
Can we turn off our mic?
Can you all
Can we turn off our mic, please, so that we can hear? Okay.
Sorry, Miss Chinasi, please, can you mute everybody?
Okay.
No, drink it. No, I'll go and quiet it. Drink it. You finish it. You finish it. You finish it. I'm going to take the white and blue.
Babalola Bamidele, please mute yourself.
Okay, sorry.
His mic is still on.
Slap it. Who asked you to take it? Baba, bring it for send me.
Babalola, right? Yes. Hello, Babalola. Babalola, you might need to mute your mic, please. Okay, I expect everybody to observe decorum. Okay, if this is your first time of having a webinar, please understand that you need to mute yourself. You are disturbing the flow of the webinar. Please, I beg all of you, mute your mics. Thank you very much. Please mute your mics.
All right. Once again, good morning, everybody, and thank you for having me. Apologies for the interruption since we started the webinar. So I guess the network kept on throwing the host out, so he lost the moderation of the whole thing. So not to waste much of our time, because we are almost 15 minutes past the start time, and I only have 20 minutes to talk about Fibonacci, which of course we all know. To talk about Fibonacci is actually a whole course on its own, like a whole course on its own, because it's very, very, very wide. But I will try as much as possible to go into like some introduction and to tell us what Fibonacci sequence is and how we could actually apply it in our trading while trading. But of course, this might not be exhaustive enough. So probably the team might actually come up with another webinar later for Fibonacci alone. So let's just quickly go through Fibonacci together. And to make it clear, Fibonacci is not for beginners, at least it's for intermediate traders. So I expect some of us to have like a background of what is called candle patterns, chart patterns, candle formation, support and resistance. We should be able to understand what is called a support and resistance. We should be able to know what is called candle formations, chart patterns, and all sorts. So today's lesson, we'll be looking at Fibonacci, and our lesson content will be looking at who is Fibonacci, Fibonacci sequence. Fibonacci sequence, we'll be looking at Fibonacci rabbit case study, importance of Fibonacci ratio, and application of Fibonacci retracement and extension. And I'll be doing this in the next 14, 15 minutes, because I need to wrap up this lesson in the next 14, 15 minutes. I don't know how I want to do it, but I hope I'm able to like impact some knowledge within that short period of time. So who is Fibonacci? Who is this guy, Fibonacci? We trade Fibonacci. We have Fibonacci tool on our MT4 chart, and we really want to know who this guy is. So his real name is called Leonardo Pisano, and is a famous Italian mathematician. So people call him Fibonacci because he came up with the Fibonacci theory, and he lived between 1170 to 1250, which most of us, even our fathers, our great-grandfathers, were not born at that point in time. He introduced the Indo-Arabic number system in Europe, and that's a bit about Fibonacci. So we want to look at Fibonacci sequence right now. Fibonacci sequence are a set of numbers starting with 0 and 1. And it is created by adding the first two. It is okay, sorry. All right. Let me just drag this a bit so I can have a good visibility. So like I was saying, the Fibonacci sequence are a set of numbers starting with 0 and 1, and it is created by adding the previous two numbers. Take for instance, look at the sequence we have on the slide. We have 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on. To derive our Fibonacci sequence, after having a 0 and 1, which happens to be the first series of Fibonacci sequence, what would then do is 1 plus 0 give us 1. So get the next number with the 1 plus 1 give us 2. So get the next number with the 2 plus 1 give us 3. The next number 3, 2, 5, 5 plus 3, 8, 13 plus 8, 21, and so on till infinity like that. So that is how we derive Fibonacci sequence. And after the 8 sequence of all these calculations, there are always constant relationship in those series. And I'll give you a perfect example now. So the statement is after 8 sequence, which is, that means after 0 is not counted. 1, 2, 3, 4, 5, 6, 7, 8. So if you divide 34 by 55 on your calculator right now, just press 34 divided by 55, you will automatically get 0.618. If you do 34 divided by 55, by default, you will get 0.618. If you do 51 divided by 89, you get the same number. 89 divided by 144, you get the same number, and so on like that. So which tells us that there is something significant about 0.618. And if you do the reverse, like instead of doing 21 divided by 34, do 34 divided by 21, you get the inverse, which is 1.618. If you do 55 divided by 34, 89 divided by 55, and so on, you get 1.618, which gives us the inverse. So it tells us there's something special about this number, and that is why we'll call it the golden ratio. And it doesn't only apply on the chart alone, it applies everywhere. If you go on Google and type the wonder of Fibonacci theories, just anything about Fibonacci, you get a lot of things about plants, how this number is being related to the human body, the year, the plants, a lot of things. As a matter of fact, the Venus, as in the Venus takes around 255 days to make a revolution around the sun, while the Earth takes 365 days for it to complete a whole year. If you divide 255 by 365 days, you get 0.618. Definitely, this is not a mere what? A mere coincidence. So let's move forward. Then Fibonacci used the arithmetic series, this same arithmetic series, to illustrate a problem based on a pair of breeding rabbits. And we'll be looking at that case study in the very next slide right now. So, Fibonacci considered the growth of an idealized, biologically unrealistic rabbit population, assuming that 1, a single newly born rabbit, a pair of rabbits, 1 male, 1 female, are put in a field. 2, the rabbits are able to mate at the age of after 1 month, which means when we have the rabbit cannot give birth until next month. Like you bring the rabbit in January, the rabbit cannot give birth in January until they grow up till February. Then for February, they start giving birth. So at the end of its 2nd month, a female can reproduce another rabbit. So rabbits never die. That's another assumption. Like, okay, we want to assume this rabbit won't die. Rabbit never die, and the mating pair always produce 1 new pair, 1 male, 1 female, every month from the 2nd month. So we want to assume for every time this rabbit comes together to mate and they give birth to 1 male, 1 female. And we'll see a graphical illustration here where I will quickly explain because of our time. Now, from the below case study, case study I just shared right now, we have a pair of rabbits in January, 1 male, 1 female. Don't forget, the case study says this rabbit cannot give birth until the 2nd month, which is February. Now, this is the same rabbit now. The same rabbit now, because in the month of February, they can now give birth. They've given birth to what? A rabbit here. You understand? So we bring the same rabbit here down, and this is their baby, which gives us what? 2 rabbits. Now, don't forget that the case study says the rabbit cannot give birth until the second month. No, this new rabbit that this white guy gave birth to cannot give birth in the month of March. It can only give birth in the month of April. So we bring this rabbit down to April, this also down towards April. This guy gave birth to another one, which is this yellow guy, and this one gave birth to another one, which is this. You understand? So which gives us like 1, 2, 3. The same calculation. 1 plus 1, 2, 2 plus 1, 3, 3 plus 2, 5. If you follow the sequence like that, till we'll get to any number of our choice. You get the point. Now, what is the importance of Fibonacci ratio itself? Number one, it acts as a scientific confirmation to our analysis. Sometimes, like I always advise people, have at least 2 and no more than 3 indicators you use to do your analysis for confirmation, for entry, for exit. If you have more than 3, it becomes analysis paralysis. So oftentimes, Fibonacci is used to confirm what our analysis. 2, it serves as a control for wave analysis trading. This is another a more advanced technical trading analysis, which is called wave analysis. So your Fibonacci, it's also used to control the wave analysis, because if you count your wave, you also need to like pull your Fibonacci ratios to get the right point. Then 3, it helps in identifying invalid zones of price action. Then 4, it helps in projecting a realistic target for your trade. And this is one of the greatest challenge of any trader. Most trader knows when to enter a market, but they don't know when to take profits. They don't know when to say, okay, I want to take half profit, I want to take full profits. And this is where Fibonacci can help you look at the trade and tell you, oh, this moving trade will get to this certain price of XYZ. And sometimes when people come on board and say, oh, gold is buying, I see gold getting to a particular certain price, and people are like, now your papa get market. You understand? But the point is, there are certain indicators that help us project a realistic target. And lastly, the cluster of 2 or more Fibonacci retracement or extension can give you a high probability trade setup. Sometimes you pull a Fibo on a 4-hour chart, you get like a Fibonacci ratio. When you go to your higher time frame, also you get that same ratio. That tells you that this trade is a high probability trade setup that can give you 90% assurance that yes, this trade is going to go in your position. So let's look at the ratios. We have what is called retracement, and we have what is called extension. So our Fibonacci retracement on your chart, when you pull it, you have 0.236, 0.32, you have 0.50, 0.618. Then if you pull the extension, you get this. And the point is, you can also add other numbers. For instance, I use also 0.786, I use 0.88. You understand? So depending on how you view your chart, depending on how advanced you are using Fibonacci analysis. That's why I said this webinar might not be exhaustive enough for us, because I would have loved to show you how to add all these Fibonacci into your tool. To get, sometimes the market can retrace more than 0.618 and retrace up to 0.88. Now, this is our last slide, and I want to go into the chart proper to like gives you let's have like an application of how to use what was it called, Fibonacci. I'll stop sharing now and share a live chat. Stop sharing, pause share. Few minutes, I'm trying to like stop sharing. Fine, okay. So I'm going to share a live chat now, and let's look at where's my chart? Okay, IBF. All right. I hope my screen is visible. If my screen is visible to you, you can give me a thumbs up. So that I won't just be talking to myself. All right. Okay, let's move on. Now, this is a gold chart on a daily time frame. We want to see how to use our Fibonacci on this trade. Don't forget, I said one thing, that you must have an understanding of what is called a support and resistance. And one of the importance of Fibonacci is for us to use it as a scientific proof of our analysis. So pull your Fibonacci. For new traders, you will always find your Fibonacci tool here, this F. Or when you click insert, you come to your Fibonacci, you can click your what? Retracement. When you want to pull your Fibonacci, you always pull from, like if you are looking for a buy, my screen is blank. Oh, wow. No chat. Wow. Damn. Sorry, let me try again. Share. Is it visible right now? No. Oh, damn. Okay. Probably I need to drop. Probably I need to drop and check what is happening on my side, and probably the next speaker can go. So by then I would have checked what is happening. I would love to show you how to apply this on the chat. So let me just drop so that the next speaker can go in order not to waste our time.
Okay, thank you so much. For that informative class. So when your screen is back on, kindly let us know.
Okay, sorry guys. I think Chinasa is having a little bit of network issues. So we would like to welcome Mr. While we wait for Olubumi Odekunle to come back in, we would like to welcome our second speaker, Mr. Adekombi Ido. Mr. Adekombi Ido, if you're there, can you give me a hands up so that I can give you
So for the
access?
next 20 minutes, for the next 20 minutes,
Yeah, hello. Hello, can you hear me?
Yes, we can hear you, please, Mr. Adekombi. Kindly go ahead, please.
All right. Am I the host now? Like, can I share my screen?
Yes, you can share your screen now.
All right, thank you. Yeah, a minute, please. Yeah, can you guys see my screen?
Yes, we can see your screen, please.
All right, thank you. All right. Yeah, I would like to first appreciate the organizer of this event, IDF Markets. Thank you guys for the opportunity of being on board today. So, and I will appreciate everyone as well that is in attendance. And I would like to say that you guys should make the best out of this, okay? All right, so without wasting much of our time, because I have just 20 minutes, but then I don't know, I know God will, okay. Can you guys see me?
Yes, we can.
All right, okay. So yeah, I'm just hoping that God help me to at least deliver as much as I could. But I think I've been able to ensure that I organize things in a way that it will make a lot of sense. All right. Okay, so today I will be talking on zones and calls in pricing. All right. Yeah, I'm Andy Convido Andre, as popularly called, a technical analyst and CEO of Enbrief Invest. All right, so that is just me. All right, so let's go on. So I'll be talking about zones and costs and pricing. So please, I want you guys to pay attention to every detail. Just like I said, there's much to say about this, and compressing something like this into a 20 minutes video, it's something that I don't know. All right, so let's just go on. All right, first I would like to talk about a disclaimer, okay, because I'm someone that is always very cautious. And yeah, I know how things can be, especially when it comes to forex trading. All right, this is a forex trading seminar in which all I will discuss is but for awareness and educational purpose only. Therefore, I will not be liable for any rational or irrational decisions that could be made by any participant who, in his interest, could independently utilize whatever is opinionated. Lastly, trading the stock, forex, commodities, crypto, and other related leveraged markets or products hereby mentioned or not mentioned is very risky and could result in the loss of all invested capital. Andre. All right. So with that being said, let's go on to what we have on board. Don't forget that what we are talking about here is the zones and costs and pricing. All right. And yeah, let's see what we have. Now, when we want to talk about the trading market or the economy market generally, what exactly are we interested in? What are we interested in? What really are we interested in? The first thing we are interested in is the aggregate activity. That is the macro structure. That is the bigger view, the global view of the market, the larger view of the market. So the aggregate activity is very, very important when we are talking about economy as a whole. All right, talking about the market, talking about pricing in market and all other things. So it is quite of great importance that we first note that we are really dealing with the macro structure. However, but more than just adding up markets, that is more than the bigger view, more than those aggregates. You know, aggregate is more like adding small things to a bigger one. More than just adding up, we need to look at the individual behavior as well. All right, this is as well very, very important. The individual behavior, that is the microstructure. Okay, so yeah, so that is the interest. That is what we're interested in when we want to talk about trading generally. You know, trading is very related to economy. Like it's 100% about economics. It's 100% about everything that economy is around the globe. All right, so yeah, that is the interest, what we are interested in. Okay, let's move on. Okay, now the theory. This is where we come into place. This is where we want to really discuss and really go in depth about what are we really doing. Okay, what are we doing? The theory. The theory of pricing does not furnish a body of settled conclusions immediately applicable to policy. It is therefore a method rather than a doctrine, an apparatus of the mind, a technique of thinking which helps its processor to draw correct conclusions. What do I mean by this? When you talk about economics generally, what we are talking about is basically talking about predictions. What we do, you know, what we do in economics is basically about prediction. In trading, it's all about prediction. It's all about trying to at least argue based on some things, your knowledge, based on your thinking and all. So with that, you are able to come up with a theory. And what do I mean by a theory? Your theory is your strategy. That which you use, the way you see the market, the way you understand the market, the way you apply. Just like my former speaker was trying to emphasize on the case of Fibonacci and all. That is a tool as well in that people use in the market. All right. So the theory is all about your theory. It's all about your strategy, how you see the market, how you want to approach the market. However, there is something here. He said it does not furnish a body, all right, of settled conclusions immediately applicable to policy. That is, when you're talking about your strategy, it's not something that it's already designed, all right? Every strategy in the trading market is something that is developed even from the market itself, from deeper understanding of the market. So it's not something that has been already prepared. It's not something that you've already had intention of or to apply. So it's not something you immediately apply. It's something that you put to the test of time, all right? It is therefore a method. It is a means, okay? It is a way rather than a doctrine. It is not something that, like I said earlier, it's not something that has been written down. It's not something that we have it all there already, okay? So it's not a doctrine that you must follow. It's something that is subject. Don't worry, by the time the next slide now, we'll talk about the characteristics of the theory, of your strategy, you know, when you are dealing with the zones and cost of pricing, when you are dealing with, you know, predictions of prices, there are things that you want to look at. So it is therefore a method rather than a doctrine, an apparatus of the mind, okay? A technique of thinking, which helps its processor to draw correct conclusions. Like I said earlier, after you going testing it over time, checking out, back testing, and the likes like that, that is when you can be able to like draw at least nearly correct conclusions. Okay, let's go on because of my time. Now, the price predictions itself, which is the core that we want to discuss here. The price prediction, that is the zone and core of price prediction, is what we really want to discuss here. Now let's look at it one after the other. Let us see how it flows. All right. Please, I want you to thumb up if you guys are still with me. Are you guys still with me? All right, thank you. Yeah, thank you. Price predictions. What therefore makes a good model of price predictions in its zone and core is a metaphorical map. What do I mean by that? What makes a good model? What makes a good strategy? Please, when I use strategy, when I use model or theory, as time goes by, as I continue my presentation, we should, please, okay. Are they waiting to continue the recording? Hello, admin. Before I continue, or I can just continue, please. Hello. Is the admin with me? They left already. Oh. Please, I need to know if this thing, so that I won't just, because I think the recording is very important. All right, please, a minute. Let me see if at least there should be someone. All right, I think we are back. Okay. Sorry. Yeah, let's roll it. All right, so talking about price prediction, like I was saying, that whenever you hear me say model or theory, I'm talking about your strategy, your approach to the market. All right, so it is very, very important that you should understand that when you see me mentioning model, theory, I'm talking about your strategy, your approach to the market. Okay, so what therefore makes a good model, that is strategy, of price predictions? The strategy you use in predicting your price, in in approaching your price, in its zone, that is in its embodiment, in its area, all right, and core, in its depth, all right, is a metaphorical map. Metaphorical, that is, can be likened to a map, that is, can be likened to a map. And when we think of map, what do we want to think of? We want to think of directions, all right? We want to think of as well data. Map, there are some areas, especially in the ancient time, maps are very, very used and very, very useful, all right? Whereby if you are moving, then we don't have technology, you can easily use Google Map to help you and all like that. But even the so-called modern Google Map and all that we use is something that is based on already given data. All right. If there is no data and you search a certain area whose data is not registered on Google Map, definitely you won't get direction to such area. All right. So that is it. So it is likened to a map. That means we need data when we are talking about building a good strategy, building a good model in price prediction. It's in its own embodiment, in its own zone, okay, and core. So we need, we need data, we need the lens. So when you think of lens, you want to think of both the, you want to think of the zoom, okay, both the magnification and and use zooming in and zooming out. Okay, that is the global view and the minor view. So here I'm still referring back to the macro structure and the microstructure. So basically, you have to think in that area, a lens, all right? Then up a window, okay? When you think of a window, you want to think of transparency. You must be transparent enough when you are building a good strategy to include in price predictions in the zones and costs of pricing. Is something that you have to be transparent enough. Now, what are now the characteristics of this your good model of your strategy? What are the things to look into? Number one, it must be falsifiable. This is very, very, very important. Anytime you are talking about prediction, in your approach to the market, you must have at the back of your mind that whatever you are using can be in any way proven wrong. All right. For example, we are an example of a falsifiable statement. If I say it will rain tomorrow, if something that can be proven wrong, it is subjected to tests. All right. That is, it is dynamic. Of course, it can even happen and it may not happen. All right. It is different from if I use a statement of it is what it is, what it is. It is what it is. It's not falsifiable. All right. It is something that it is just what it is. Are we with me? So that is basically the whole thing. So when you are building a good model must be falsifiable, must be something that can be put to test, it must be something that is, you must not be biased. That is the truth. You must not be like, oh, this strategy 100% it is working. If I say buy, it is buy and no. So you must have it at the back of your mind that it is falsifiable. It must be validated by empirical observation. When we talk about empirical, we want to talk about experiment. That is, you want to talk about what is it called? You want to talk about experiments. You want to talk about having tested it over time, back tested it, all right, experimented it. Okay, so that is empirical observation. Then it must be logically consistent. That is it. This thing is logic. It must be logically consistent when you are building a good strategy, in the area of determining price prediction. It must be logically consistent. It must be something reasonable. And that is where the case of mathematics come. It's good that first we were first introduced to Fibonacci, and Fibonacci is derived from, series of numbers. This is mathematics. Mathematics is a step that, you want to solve what is it called? Simultaneous equation. Okay, the first thing you want to look into is the fact that you want to look at the method. And the method is what we are talking about. Now, your method must be logical, such that even if another person is using the same different approach to go for it, then both must be logical, and that is how you can come into a reasonable conclusion. All right, my time is fast spent. So it must be logically consistent. Okay, very, very important. That is, one must lead to two to three to four, and the likes like that. Okay. So it is very, very important. All right, they are writing here that you should please drop if you have any question for me, as my time will soon be up. So, thank you. All right, then it must be simple. Please, it is very important as well. Your approach to the market, as much as you may think the market is difficult and all like that, yet the uniqueness of the approach is in the simplicity. For real, it is what it is. It is in the simplicity, and it doesn't need to be realistic. You see that I separated this. It doesn't need to be, for real. That is it. It's all abstraction. It's all in the mind. Okay, it's all a game of mind. It doesn't need to be realistic. So you must not be biased about this thing. You must not be facing one direction in your thoughts when you're approaching the market. But given the choice between two equally predictive theories or models, choose the more realistic one. And the question comes again, and thus theory need to be based on a rational choice. Please, I will leave you with this question for you to answer. If we are, two equally predictive theories, which is usually the case, okay? Which is usually the case of what is it called? Of the market. It is either you buy or you sell. Okay, it is either you buy or you sell. So if one person that you know that is good is coming to you with his own theory that I want to sell this pair, and the other person is coming with you are coming with you want to buy, and you both come into logic and you both like this and that like that, and you know you just feel, oh, maybe your own looks more interesting or the other person own looks more interesting. Let's go for this one. But the question is, is it that you want to choose the more realistic one? Okay, if that is the case, does a theory, does a model, must it be based on rational choice? Must it be based on just human reasoning? So that is a question you have to answer yourself. Now, models can be deductive, bottom-up approach. It is very, very important. That is, especially when you are talking about you doing your analysis, you know, top-down analysis. We are very familiar with top-down analysis, that is the inductive part, but we should as well know that it should be deductive, that you must be able to approach from the bottom to the up. You must be able to see abstractly into the future. You must be able to check from the past time into the future time, all right? And also must be what? Inductive. All right, so conclusions. But before I go into conclusions, let me, what is it called? Before I go into conclusions, I would like to share my chat, okay, so that I can at least, let us see what we have here, okay? Okay. Okay, so let us see what we have here. So for example, look at this, my chart. I believe, please, can you see my chart? Just some of you can see my chart.
Yes, you can see your chart.
All right, thank you. So for example, look at this guy here. This is a model imprinted on this chart in order to take the trade. What do we have here? Number one, I have to look into, for me to apply my strategy here, there are some things I must have looked, and the details are hereby on the chart. Number one, I try to check what is my trend. We are in a bearish trend. All right, interesting. Then the next thing is that it must be falsifiable, in the sense that, why is this falsifiable? In the sense, this is falsifiable in the sense that you can see me putting an invalidation or stop loss. There's something I must know that, yes, if this does not happen within this range of price, then this my trade hereby becomes invalid. So it's something you must be subject, you must be open to that. Then it must be, what is it called? It need not to be realistic. And that is why you have objectives. Okay, that is why I have this low here. That's, oh, if this low is clear, then surely I can look. This low right here is an optimism. It's something I'm just optimistic about. It's not necessarily a target that must be met. All right. So all these things combine together, then finally my expected destination. So all these things are logistics that must be put into that must be in your mind while you are reasoning a way out of developing a model. All right. So let's go back to the chart, to the presentation, and so our conclusions, because my time is fast spent. What does the algorithm say? Our task, as I see it, is to write a Fortran. A Fortran is more like a computer programming language, you know, Python and the likes like that. Program that will assess specific economic policy rules as input and will generate as output statistics describing the operating characteristics of some time series we care about, of course, which are predicted to result from these policies. Now, look at my headline. The algorithm says, you know, this is what now differentiates the Forex market. This statement was released by Harry Lucas Jr., you know, an economist in 1980. So this statement here is only talking about what is now presently happening. The technology that has, you know, interestingly brought the Forex market the technology that has brought the forex market into to all of us. You know, not as if we have what is it called? Not as if we have the money enough to actually participate in this huge market, but technologies has made this so interesting that even we now have, you know, brokers just like IBM Market that is hosting us today to actually, you know, deal with codings, algorithms. You know, we bring in the economy into a coding style, into an algorithms. And that is where we can have, you know, closer prediction. That is what this statement was saying. This statement actually spoke into the future, and that future is here. All right, that future is now. And that is why we have to maximize that opportunity. Because now we now have our economic policy rules being put as input, being put as charts. All right. And they're generating output statistics. That is it, they're showing reactions based on previous data, based on maybe fundamentals, present data, you know, fundamentals showing the macro area of the market and everything like that. Describing the operating statistics of some time series we care about. Definitely, everything is dependent on time, which are predicted to results from these policies. Now, the fact. What does the fact say? The fact says the theory that planetary orbits are ellipses is only approximate if measurements are made carefully enough. Now, you know, we if we are science students, we are familiar with the whole theory of planetary orbits. The Earth is spherical in shape and everything like that. You know, even there were this thing about the Earth was what is it called? Was circular. So different thing like that. But this theory about the ellipses of the Earth, about the ellipse shape of the Earth, is only approximate. That is only approximate to be true. You know, our predictions in the market is only approximately true. Okay, if our measurements, if our strategy, if our approach to the market as well actually undergo all the characteristics of a good model that have initially discussed. So if measurements are made carefully enough, so that is the only thing. So it is when your model is good that you can have approximately good measurements. It does not seem helpful to say, therefore, it is false and should be rejected. You know, the fact that it is until we have a well-refined strategy, a well-refined approach to the market, that we should now say that, because we need to undergo all this stress, all this, idea, all this thinking of refining our strategy, of making it better, does not falsify the strategy. Does not mean that you should reject it. Does not mean that forex market is false. Does not mean that forex market is a scam. Does not mean all these things. All right. So, and it doesn't also mean that it should be rejected. So we are likening it to this planetary theory that even though it seems not so practicable enough, but until it is well refined, that we can actually approximately say that, yes, this is correct. Okay, furthermore, theories can be so complex that they do not actually allow important data reduction, even though a naive hypothesis testing view might accept them as being what? Has been through. Now, at times, your theories can be so complex in view. You know, for example, let me talk about approaching markets with something like Elliott wave theory and the likes like that. But such that all those ones does not, they don't really allow so much of an intrinsic value, so much of a micro approach to the market. Okay, but even though people still use it, you know, an hypothesis testing view might just be acceptable to them as being true. All right, so please, I hope we have really gained something. I hope we have learned a lot. I hope we have seen why developing, why approaching the market. Either you are a beginner, either you are an intermediate trader, either you are an expert. So I hope we want to keep it at the back of our mind, everything being discussed and every characteristic of this a model approach to the market. All right. So yeah, thank you so much once again, IBF Markets, for hosting me. I hope I've been able to deliver accordingly. Yeah, thank you. Bye.
Okay, thank you so much, Mr. Idu, for that informative class. Thank you so much. We have a question here. Mr. Kimbo would
Please, I
like to
can't hear you
know,
clearly. Is it possible
and
that the
what do
other,
you think?
hello? Is it possible that the other person take over, please? I think our network is not good. It has not been good.
Okay, sorry about that, Mr. Adekombi. I think you can hear
Yeah,
me
it's
clearly,
fine.
right?
You
Okay,
said?
so I think you can hear me clearly, right?
Yeah, I can hear you clearly.
All right, so let me read the questions out. So the first question we have here from David Matthew, it says, what is the stipulated time for a strategy to be tested, back tested, and proven before used? Can you please answer based on your own strategy? That's just one question. So do you want me to take all the questions, or
Let
you want
me
the questions?
answer this one by one, please.
All right, no problem. Please go ahead.
All right, for that one is a straight answer though. So what is it called? So back test a strategy can take, as you know, it depends on who you are. If you are a beginner, I will advise minimum of 4 to 6 months. So backtest your strategy, see it over time, backtest it on demo, see it playing out over time. However, generally, backtesting a strategy should only be conclusive, just like everything that I have said. Conclusions of development of a strategy or of approach to a market should only come after it has undergone the test of time, after it has shown consistent results. Okay, so that is it. So be it is after a year that shows consistent results over your practice, then that is when you should go live. That is when you should see it as something you just want to adjust. And another thing I must add is the fact that please, after you backtest your strategy and you can see 70, even 60% accuracy, trust me, with your risk management is something you can go on with. Thank you. Next question, please.
Thank you,
Hello?
Mr. Adewus. Yeah, thank you, Mr. Adewus. Let me go to the next question now.
Okay.
The next question reads, and that is from Fanny B. James. Is market really a game of psychology, or just what some individuals control and expect us to be reacting to it one way or the other? Yeah, the question is quite funny. So but I think you should let me just read the second question before, because I know that one is quite straightforward. Then the second question, or the third question, is from Akibogu Ebenezer. He said, Mr. Ide, thank you so much. Please, how long have you been trading Forex, and what can you say is the main problem the majority of retail traders face? Yes, sir.
Okay.
So over to you.
Okay, thank you. The first question talks about psychology. See, psychology is everything in the market. All right, psychology is everything in the market, and everything. By the time probably you have access again to this video, or you think over it or over it again, you will see that everything I've discussed is still talking about the psychology of the market. All right, it's talking about the psychology of your strategy. Psychology is in various forms. It's even beyond what is it called? It is beyond either because it involves money, because I don't want to lose money or not. In fact, that is even a minor thing. Psychology is based on even your strategy. For example, if you are probably someone that uses just support resistance to trade and everything, as time goes on, you find it difficult. You only see market in that way. For example, I don't use what is it called? Probably I don't use much of patterns to trade. I don't use all this head and shoulder and the likes like that to trade. And one way or the other, my psychology has mastered to that effect, such that, trust me, I don't see head and shoulder again in the market at all. I can't even remember the last time I've spotted it. But meanwhile, someone that traded, once the person opens, in fact, the person may be pointing to me and be like, that is head and shoulder now. That is inverted this thing now. That is falling wedge now. That is this, that is that. Meanwhile, I don't see them for real because I don't use them anymore. All right. So so psychology is everything in the market. And this case is not a gambling case. And that is why I drive out my conclusion based on the planetary theory that even though this seems so irrelevant, it's abstract, it's not something that we see. It's not something that seems to be so true until there is a good model that will refine it all and make it approximately true. So it is until you can actually do this and master your psychology along with it that you can actually see the reality, that you can actually move away from the side of, oh, it's all us but a gamble or a waste of life. Trust me, it's worth the whole thing. It's worth something that one could spend 7 years in university studying, and it's worth it. Like at the end, it's worth it. And the second question, we talks about how long have I been trading? Well, I've been 4 years in the game and still counting. And we thank God it has been series of ups and downs, different strategies, different refinements, and everything. And that is another thing. You have to be dynamic with your approach. You have to be dynamic with your approach of the market. You have to be dynamic with your approach of the market. So yeah, so that is that. So is there any other question?
So I have the final set of questions, and after that, we thank you very much. So, Afizola DH says, if you don't mind, who is your mentor and who inspires you? And someone also asked, Joseph Kanife says, please, where is it appropriate entry to place a trade at lower risk? Yeah. And then also the last question also, someone also says, will you advise beginners to buy strategy? So that'll be all the questions we take.
Will you advise what?
Beginners to buy a strategy.
Okay, all right. So the first one talks about who is my mentor, right? Yeah,
yes, please. Yes, please. Yes, please.
All right. So, well, my mentor and myself mentor. That is one funny thing. But of course, I've undergone some courses from other people. But trust me, everything I am today, everything I do today is basically based on my understanding of the market, in-depth refinement of the market. And if you've heard me speaking, even if it's just this once that you've heard me speaking, you can at least perceive the in-depth understanding of the market that it's far beyond whatever I'm discussing, is far beyond being taught a strategy or someone telling me to buy or to sell. So it goes into me refining all strategies that have come across and coming out with a conclusion, okay? And that is all I have been trying to emphasize on as well, that it's based on you and you alone in the end, refining your all strategies you come across and coming to a conclusion after putting them to a test of time. Okay, so I'm myself mentor, or let me say poverty is my mentor, or financial freedom is my mentor. You know, I'm not somebody that wants to work 9 to 5. I'm not somebody that wants to be paid salary. Okay, so that has always been my goal for years. And yeah, I think when I see this legitimate business, I just want to like be there. All right, so the other person talks about what is it called? Talks about risk. Okay, the other person talks about risk. Now, the risk approach and also like the refinement of time frame. All right, see, it depends on your strategy, trust me. And it depends on the type of trade you are taking. A swing trading a trader, that is a long-term trader. Are you an intraday trader? I'm not like that, okay? Personally, I go as low as 1 minute for refinement to maximize risk to reward. But at times, I don't even give a damn. At times, I stopped on 15 minutes, 30 minutes. Once I see that, okay, the risk involved is something that I can bear, okay? Oh, at times I might be, you know, at times it might even be so hard to refine your area of interest, if you don't want to miss a trade. So that you just want to agree with, okay, 20 pips stop loss is fine, 30 pips stop loss is fine. And I'm sure some of the people asking this question are from my Signal channel, that they have seen me probably using 2 pips stop loss and the likes. But that one at times doesn't always happen. Okay, it doesn't always happen. At times you want to give your trade rooms to breathe. So it all boils down to risk management and knowing what you are willing to risk as per your capital at that point in time. Is it 0.2% you are willing to risk, 1% you are willing to risk? Okay, it's all about the risk to reward. And the last person is asking about my is asking about buying a strategy. See, the issue with that is that buying a strategy, you should have a mentor. Trust me, you should. It will help, for real. It will help. I've seen a lot of students have trained that, you know, they get to be fine in just short period of time, what takes me years to actually reach. So that is the work of the mentor. But just be sure that you are approaching the right person. Just be very, very sure. It will really help you, because at times it may be difficult to actually understand it all. All right, so I hope that is all right.
Yeah, that'll be all. Thank you very much, Mr.
All right,
Adekom.
thank you
You've
very
done a
much.
lot, you've done justice to this. Like you said, or like the first speaker said, it can be exhaustive. Right now, I will be handing over the microphone access to Samuel Dina. He will be introducing, we're reintroducing Olubumi Odekunle, who was our first speaker, or is our first speaker, but had to like uh, briefly jump out and come back in because of some technical issues. So I hand over to Samuel Dina. Over to you, please.
Okay, good afternoon, everyone. Thank you, Mr. Andre. Thank you, Chinas. I can see that your network is not so good. And, yeah, from this section, it's been impactful. Personally, as a trader and as a trainer, I've picked one or two things from everything that Mr. Andre has been able to communicate with us. And then, of course, I will make use of it from here. And I believe everyone that is listening to us will do the same. Okay. My name is Samjin. I'm the trainer in IBF Market and the head of analysis. And in IBF, what we do is, because, of course, most of us, we still need to go back to basics and learn one or two things. You know, it's a gradual process. We need to develop as a trader. When we talk about strategy development, it's a phase. You know, first of all, you must have a strategy. And before you have a strategy, you must understand the basics of trading, which takes me to training now. Now, in IBF Market, we run one of the best training in town. Of course, we are proud of that. And if you join us for 1 week training, of course, at the end of the training, which is 1 week at a stretch, you should be able to stand on your own as a trader. So from Monday, we run trainings on Monday. The basic class starts on Monday at our office in Lagos and in Kaduna. Mondays, we run basic trainings. That is, if you are new to Forex, you need to know the basics of Forex trading. Of course, you can join us on Monday in our office from 11 a.m. Then on Tuesday, we'll do the continuation of the basic training, because we try to, make sure that people understand the basics very well. When you have a very good background in this industry, of course, you are going to do well. So on Wednesday, we start our technical class, which has to do with the intermediate class. And on Thursday, we do the continuation of the technical class, which is actually the strategy class, where we give you strategy to trade, where we show you what to do, how to place trades, what you need to look out for before you place your trades. And on Friday, we talk about fundamentals, the effect of fundamentals, what you need to know about fundamentals. And we talk about also the MM101. I call it MM101, which is Money Management 101. It's very crucial. After everything that you've learned, you need to learn about money management. Okay, so by popular demand, we'll be going back to Mr. Odebumi all the way from Germany to continue his training or his teaching on the Fibonacci Miracle. Mr. Bumi, are you here, sir?
Yeah, perfectly
Okay,
with
so
you.
I'm handing over to you, sir. Thank you.
All right, thank you very much. And I want to appreciate the last speaker, Mr. Adekombi. Yeah, nice insights, as in that was really insightful. So quickly, I'm sorry for the technical issues. I would really love to show you the charts, and let's have a feel of how Fibonacci can be used in our trading system. Okay, I'm sharing right now. Is the chart visible? No, or is it still blank?
Precisely visible, heavily visible.
Oh, hallelujah. All right, nice. So quickly, I spoke about, let me just minimize this. And all right, I spoke about the Fibonacci sequence, and we're able to look at how we arrive at the golden ratio called 0.618 and 1.618, which is the inverse. And if you go on Google and just type all these thing on like wonders of Fibonacci, they will always, as in the results you get, will always give references to that 0.618, which is the golden ratio. And personally, I feel it's not a coincidence. And over time, so we've seen a lot of people use this in stocks, indices, metals. Surgeons use it for the body to get one or two things and all sorts. Plants, they use it for plant, they use it for a lot of things, and it breeds results. I've been using Fibonacci for close to more than 7-8 years, and I learned it from one of my mentors who was supposed to also be a speaker today, and she's not here. I call her the Fibonacci queen. So quickly, if you want to pull your Fibonacci, this is a chart. This is a go chart, a daily chart right now, a live chart. If you want to pull your Fibonacci, like I said during my teaching, I said the prerequisite for using a Fibonacci tool is for you to understand the basics of trading, which is the support and the resistance, the candle patterns, and also because Fibonacci follows price action. It respects support, it respects resistance. And for you to like take your entry, you need to understand what the candle pattern is saying, what the chart formation is saying also. So to pull a Fibonacci in this chart right now. Now, from this chart, we're having a downtrend. You could see a downtrend, right? And there is a candle pattern here right now. There's a formation happening here. The chart here is going up, and all of a sudden, there's a retracement right here. We want to know if this price will continue to move forward up or will continue to go down. This is our low here. And for those who understand support and resistance, even with your naked eye, you could see some price action where you could pull your lines to find some support and resistance. Like I can pull my support, say my line here to get a support and resistance, which we have like a price here. We could do another one from this place. Can you see? Like a rejection. We could also pull from this place to see this, or just to like come up straight here, or just to do this. So it depends. So you should all have like a background of what is called a support and resistance. Personally, I don't use indicators for support and resistance. You understand? As a newbie, you could use indicators to help you identify your support and resistance. But because I have like an understanding of the market, even with my naked eyes, I could see where there are price reactions, where I could pull my support and resistance. So let me just delete this and let's go to Fibonacci. So to draw your Fibonacci, there's a tool here, this F2 is called, can you see it say draw Fibonacci retracements? Or you come to this insert, then go to Fibonacci, go to retracements, click on your retracements. For you to pull a Fibonacci when you're looking for a buy, you pull from the low to the recent high here. Can you see? Then you leave. So from what we'll see here, you could see there is a rejection, like price was moving. This is our, like say X, 1, 2, or say 1, 2, 3, you understand? Price move, like we had a rejection here based on this support now. You understand? Price was moving, blah, 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 and there was a downtrend and it rejected this place. And we have another pin, which is like a bullish candle, which signifies, yes, okay, we could do a buy here. But unfortunately, wearing in this position, in this trade, probably you went to watch Man U, or you were playing video game and all sorts, and you didn't see this trade. And like, oh, I've missed out. Like, so how do we identify when to like enter a trade? How do we project where to take our profit from this trade? Now, let's take a look at this. Price moved up here. This is our low. This is our high. And we have a retracement here. can you see that price retrace at between 50.0 and 61.8? So oftentimes, not always, for emphasis purpose, not always. Oftentimes, you will always get a rejection at this range, 50.0 or 61.8. As a matter of fact, when I see a rejection at a 61.8 with a price action, take for instance, look at this candle. Let me maximize my screen. Let me quickly maximize the screen. All right. Now look at this candle. Majority of people might enter this trade and feel, oh, let's continue selling. But unfortunately, there was a bullish candle which engulfed this, even the second candle, which was like a price action. And we could see that price couldn't break past this 50 and 61.8 Fibonacci. Personally, if I'm to take this trade, you understand, I would rather wait for a break of this 338.2, take my buy to give me a confirmation that yes, this is a buy signal, or wait and see if price will retrace back, because sometimes price will come back and still retrace and want to test this 61.8 itself before going up. You know, price does not move in a straight line. So most times price will still want to like come and do this 61.8. That this is what we call 0.618, and before moving forward. So for someone who wants to take this trade now, you have to wait for a successful break of 38.2 to show you a bullish trend, or if there will be a rejection of 61.8, and if there is no rejection of 61.8, then definitely price might actually get to this place, which is the 78.6. This line I pull here is 78.6. So if you add your Fibonacci here, let me do Fibonacci properties, parameters, Fibonacci level, sorry, and say hard, 0.786, which is 78.6. Can you see? Can you see that it is exactly why I pulled the support line? This is where the 78.6 Fibonacci level is. So that is why I said sometimes this thing comes with experience, and this class might not be exhaustive enough. So sometimes when I see a trade, I could actually tell, oh, this trade is 38.2 Fibo retracement. This trade is 61.8 Fibo retracement. This trade is 78.6. And if you displace this low here is actually something around 88.2, 88.1, 88.2 thereabouts, if you calculate this also. But most times I prefer the maximum retracement. I would always prefer to take a trade on is 78.6. So if there's a rejection here, the price might actually do like a retracement back between 61.8 and 78.6 before going forward. So my key levels are always between 50.0 and 61.8, then between 61.8 and 78.6, looking for a buy. Now, let's take for instance that okay, we want to take a buy from this place. Where do we take our profits? Where do we put our stop loss? If you take a buy from this place, you understand? By default, the rule says your stop loss should be at the low of the previous candle, which is this. So your stop loss should be around here. But because sometimes the market still wants to hunt stop loss before going forward, I always prefer putting my stop loss below 61.8 Fibonacci retracement. But in an instrument such like gold, if you place a buy here and your stop loss is here, your stop loss is very, very wide, very, very wide. And for those who trade with low capital and might not have enough funds to hold this trade. So I look for high probability trade, probably around those places. If there is a reaction here, I take my trade here, then I put my stop loss here. So most times the stop loss is around 20 and 30 pips. But if you look from this place, it's a whole lot of pips. But the beauty about it is it's not even about the number of pips, but what is the ratio? What's the RR? What's the reward ratio? Like the risk reward ratio? Yeah, that's right. What's the risk reward ratio? How much am I risking in this trade, and how much will I be able to profit if this trade goes in my favor? So let's look at where to take our profit now. Don't forget, we are saying, okay, we are taking our buy here. Where do we want to take profits? So let's remove this. Sometimes there are two ways to go about this. Is either you use the same Fibonacci retracement tool and pull it the other way, or use what is called Fibonacci expansion. And I will show you both here right now. This is my Fibonacci retracement. You know, we pulled this way from low to high. And for the purpose of this trade, I want to name this place 1. I want to name this place 2. I want to name this place 3. In the Forex market, this place is your X. This place is your 1. This place is your 2. But for ease of understanding, let's use 1, 2, 3. So to pull this thing, we'll pull from 1.1 to 0.2 to get our 0.3, which sometimes, even when you buy an India called 1, 2, 3 pattern, yeah, there's an India called 1, 2, 3 pattern. These are what the India looks for. 1, 2, 3, then it gives you your green arrow and tells you buy. So even when you buy all those indies, you need a good understanding of some technical tools to help you confirm what those indicators are telling you, what those custom indicators you bought, what they are telling you. If an indicator is showing 1, 2, 3 pattern, and you pull your Fibonacci from the 1 to 2, you understand, and the 3 is not giving you a strong Fibo ratio with a cluster of some support, definitely that signal is invalid, which is one of the importance of our Fibonacci tool to help us identify invalid zones. So let's pull to the inverse now to get where we need to take profits. So, you know, we put from 1 to 2 before. Now we'll put from 2. You can either put from 2 to 3 or 2 to 1. I need to minimize this back, sorry. All right. So we'll put from 2 to 1. Now look at our 161.8 Fibonacci extension. Can you see that it's also like it's a place of a major resistance where we have enough price action? So if I take my buy here right now, this is where I'm looking to take my profit out. Sometimes for conservative traders like us, we want to take our profits in batches. So instead of pulling from 2 to 1, we'll pull from 2 to 3. Can you see? Then we have another resistance here, which is like a minor resistance before we get to this place. We say sometimes when price gets here, you know, like we always say, price does not move in a straight line. When price gets here, the price might still want to do back, and do nonsense and come back to 100.0 before going up here. So if price breaks this 1.6, 1.8, then we are sure of what this zone. Now, let's use the Fibonacci expansion. You come to your insert, Fibonacci, then you go to your expansion. So the rule for this expansion is to pull your Fibo from 0.1 to 0.2. Then you pull back this leg, not to 0.3 now, back to 0.1. Can you see? Back to 0.1. Can you see? It gives us the same place we pulled our Fibo, the same region. Can you see this region? The same place. So if you are taking our buy from here, we are looking at taking profit from those places. Are we understanding? All right. Now let's look at this same chart from another higher time frame. Delete. Okay. Let's go to weekly time frame. Now let's pull this. Let me remove all this, all this. From the daily time frame, we saw a buy movement. You understand? From the weekly time frame, you could see price that has been going up. Then all of a sudden, price is coming down. Now, what I do here majorly is to use my monthly and weekly charts as the bed view, overall movement of what the market is saying. Then I go to the lower time frame to pick the market. Now, the fact that we are taking a buy here does not mean this weekly market here that is showing sell will not sell. If I pull my, this is where we said we want to take profits here, right? Yes, I guess this here, this is the place. If you go on weekly, look at it here, the same place. Now, if I pull my Fibo here now, no, the last explanation was for buy. Now we want to look for a sell. This is our first high, right? This is our first low. What did the market do? Can you let me remove this white line so it's visible enough for us? This is a 61.8 rejection. As in, this is a perfect, like a perfect rejection. See, this candle here, perfect rejection. And it gave us what? A pin. As a matter of fact, if I were to be in this trade, I will take my sell immediately. Now, let's look at where to take profits here. Let's see where this market actually got to. Let me remove this. Let me minimize this back. So, you know, we pull from this place to this place. Now I want to pull back to this place. Let's pull to this two. What did the market do? Can you see that the market gave us 161.8? The market actually got to 161.8 before going back. You know, I said you could actually pull back to 1, 2, 3. You could actually pull back 2 to 3 or pull back to 2 to 1. Which is why I said sometimes for conservative traders, they love taking 2 to 3 first because it's easier to hit your target faster from this place. Then after you hit your target faster, then you can now pull from 2 back to 1, where you have here, where you know that price can still come to this range to hit your profit. From this market, the overall movement of this gold is a sell. And what this market is trying to do is trying to tell us that yes, the price is coming here, but price will still go back up. And that is what we saw on the daily time frame. Price will still play around this zone. And you could also see that here, you know, this is the first line we'll pull from this place to this place to get this place. Now, the market did another low here. If you look at that low, see, the market still did another 61.8 here. That is why we have this again. So it depends on what you're trading, how do you want to do this, and how you want to apply it to your trading tools. We can go on and on and on and on because of our time. I would like to stop here and take questions. So probably the head of market research might want to like do another class for strictly Fibonacci so that we can have an exhaustive view of how to apply both the retracement and the extension. So I believe the little I've shown you is enough to like convince you that yes, Fibonacci is powerful, especially when you have the cluster of 61.8 and 161.2. And one thing I forgot to tell you is that when you have a rejection at 61.8, the opposite direction of the profit taking is always, most times, 161.8. 161.8, and the moment you achieve 161.8, the next thing you want to achieve is 26.1.8. This is what I'm talking about. 161.8. The moment you achieve 161.8, you want to achieve 261.8. So in the long run, well, probably because of some fundamentals that is still holding gold back, I expect gold to be on a down move. Thank you very much for your patience and for having me. Thank you. I would like to stop here right now.
Okay, thank you, Mr. Odebumi, all the way from Germany. Thank you for taking us through the Fibonacci Miracle training. Of course, I know that 1 hour is not enough to go through Fibonacci training. So because of this, we'll be looking to do another webinar probably in the next 2 weeks for Fibonacci retracement, okay? And Fibonacci Miracle training. Okay, now moving forward, we have one last section that will be taken by Mr. Chuks Obiri, and he will be taking us through on the mindset of a successful traders. Mindset of a successful trader. But before his section, I would like to give us some information about IBF market. Of course, as we all know, IBF market is a brokerage firm, okay, and it's a brokerage firm by traders for traders, like we all call IBF, okay. So, and in IBF, we have a lot of packages for our clients. Now, aside from the fact that you can use our platform to trade, there are also investment plan. We have the pool fund, and under our pool funds, of course, annually you get about 60% return on your investment with IBF market. Okay, and aside from that, if you are a trader and you would like to trade on our platform, of course, if you check, you will see that we have one of the lowest spread in the market, one of the lowest spread in the market. Our service is top notch. We have our live chat 247, and also we have a bonus package that is running. Of course, the bonus package is closed for now, but for the sake of this seminar, we have to open it again for people that will be joining us. So if you are joining us and you would like to, of course, trade on our platform, we are giving out a 50% bonus specific for people on this platform right now. So you can go on to ibfmarkets.com and register, and you'll be qualified for the 50% bonus, which will actually help your leverage in the market. Okay, and aside from that, if you are not so good in trading, you can't trade by yourself, you still need help. While you can join our training, like I said before, but while you are also going through our training, you can fund your account and we'll add you up to our free signal group. Yes, we have a free signal, a very vibrant free signal group, which means that while you are still going through your training, you can actually be earning, and money should be coming in little by little as you are going through your trainings, of course. So it's a free signal for everyone who is our client on IBF market. Like we said, in IBF market, our purpose, our aim is to make sure that we raise successful traders. There are myths flying around about trading in Nigeria, specific to Nigeria. You see a lot of people calling trading scam, is gambling, is all that. Of course, Mr. Andre have actually addressed that. It is not a scam. There are people making legitimate money in this market. Just visit the ibfmarkets.com, and then, of course, from there, you can get our free bonus, and we can add you up to our free signals when you fund. Now, moving forward, I will be handing over to Mr. Chuks to take us on the last section for this webinar. Of course, Mr. Chuks Obiri is our country director. Is country director of IBF Market. He's an experienced trader. He's a well-known trader and a major guru in this industry in Lagos, Nigeria. Let's make welcome Mr. Chuks Obiri.
Good morning, everyone. Samuel, thank you for the accolades, but I think you are kind of overshooting my reputation and overblowing my reputation here. Okay, so hello guys, welcome. I want to use this opportunity to welcome all of you to this webinar. It has actually been a real financial expo like we anticipated. It's been very interesting so far. I've also learned a lot from both speakers on the Fibonacci Miracle, and also I've also learned a lot from the Combi. Thank you guys. I really appreciate what you have done so far. Okay, so without further ado, yeah, I would like to take us on the mindset of a successful trader. The mindset of a successful trader. One second, I'm trying to share my screen. Please confirm that you can see my screen, please.
Yes, we can. Yes, we can.
Okay, thank you very much. Okay, I wasn't the person who was initially scheduled for this topic. Was supposed to be Tayo Okuboyejo, okay, but unfortunately due to some unforeseen circumstances, she couldn't be available today, so I'm fitting in for her. I'm filling in for her rather. Okay, so the mindset of a successful trader. Now, I think this is the most unattended topic, okay, in the industry. Most people don't really talk about the mindset of a successful trader, or in other words, the psychology behind trading. Now, one way or the other, as Hendry was speaking, he actually touched on this topic a little bit. Now, I really appreciate what he said. It's just evidence that Hendry is actually a what will I call him now? Is actually a authority in this business. Kudos to you, Hendry. Okay, so first things first, the question is, what is a mindset? What is a mindset? Now, a mindset is an established set of attitudes and beliefs that is held by an individual. The reason why I have to bring in this definition, it's because most of us come into the FX industry with the wrong mindsets. And basically, that's the reason why we are hearing a lot of terrible stories, okay, out there in the industry. Many people came in with the belief that once I become a trader, okay, I become an instant millionaire overnight. Now, unfortunately, that's not always the case. In fact, that is not the case. Okay, and that is why this has established a set of attitudes and beliefs that is held by us. And that is why many of us keep making the wrong mistakes in trading. Now, it's very important, okay, that this becomes like the first information that traders, or let me say aspiring traders, okay, get to know of, get to hear. Okay, it's very important that people understand the right mindset for trading. If you have the right mindset, trust me, that becomes the foundation for your success in the business. Okay, I'll take it again. A mindset is an established set of attitudes and beliefs held by an individual. Now, with the right information, you have the right set of attitudes. To bring a little bit a further explanation into this, you will agree with me that we are actually products of the things we hear. Somebody is a professional accountant, okay, because when he went through the university, they taught him some things relating to accounting, some principles in accounting, which has become the bedrock for that accountant's career, okay? Now, the truth is, somebody who is not an accountant cannot fit into that role effectively, okay? So an accountant has a mindset of an accountant, okay? An engineer has the mindset of an engineer, okay, because they've been taught some set rules, some set principles over time that has created the way they handle life. And that's why we have different people. We have people that are logical. We have people that are assertive. We have people that are intuitive. We have people that are mechanical. We have people that have different types of mindsets and attitudes, all because of the things that they have heard over time. In other words, their environment to a large extent has determined who they are. Okay, now straight to business. With a new mindset, you have new results. My job this morning or afternoon, okay, is to give us the right mindset for trading, the right mindset that you need to develop for trading, okay? So with new mindsets, you have a new result. So let's go on. Now, first things first, I want to, can I use the word debunk the conventional mindsets, okay, that is out there, okay, the traditional mindsets, okay. So my slide says conventional mindset versus trading mindset. Now you'll agree with me that the way the educational system is structured, when you go to school, okay, there is an anticipation, there is a drive for you to come tops in class, and there is this perception that if you don't come tops in class, you're not good enough, okay? And that's the mindset. So you see people struggling, painstakingly putting in a lot of effort, okay, to become tops in class. But it's shocking that today, even those guys that are the bookworms, the nerds in class, don't end up becoming the wealthiest. Okay, I'm sure some of you football lovers, we know how much Messi or Ronaldo earns weekly. Okay, and then the brightest of minds don't really end that. Okay, so this just gets to show you that there is a mindset that you need to cultivate for trading. Okay, now if you look, we have two heads in this slide. Okay, one has a trading mindset, the other one has a conventional mindset. Now, failure is an opportunity to grow. Now, it's very important to realize that in trading, okay, failing is part of trading. How do I mean? That is why you always have a stop loss for every trade you are putting on. Okay, because in trading, it is very important that we all get to understand that trading is based off probabilities. Now, it is not a, can I use, it's not cast in stone. It's not a straight jacket way of doing things, okay? Like Andre was saying, is a theory, right? It's a probability, meaning it could turn out in favor of A or it could turn out in favor of B. So you need to appreciate failure, okay? Thank God for motivational speakers. They're beginning to understand that, oh, for the fact I failed, yes, doesn't mean I cannot do it again. So you need to have that mindset, okay? And trust me, failure is an opportunity to grow, and that's a growth mindset, okay? Now, on the other hand, on the other one, where we have a fixed mindset or a conventional mindset, Failure is the limit of my abilities. That's what's written there. Failure is the limit of my abilities. Now, the truth is, for the fact you fail, people look down on you, talk you down, and make you feel like you are not competent enough. But that's not how it works. Okay? Now, I can learn to do anything I want. Okay? When it comes to trading, you have that I can do mindset. Okay? Now, I just needed to emphasize on this, that the conventional mindset makes you believe that if I fail, I'm not good enough. But in trading, okay, you need to learn to what? Appreciate failure. It's part of the growth process. Okay, so I'm continuing, moving on to the next slide. Now, conventional mindset versus trading mindset. Now, in the conventional mindset, okay, everything is black and white. For example, those in sciences, there's always we always postulate a law. If I remember how they say it now, you come up with a law, or rather, what would they call it now? Is it is there an assumption now? I can't remember the right word now. They call in what they call this now? Experiments. Okay, hypothesis. That's the right word. Okay, we'll come up with a hypothesis, and if that hypothesis actually is adopted, then it becomes a rule. Okay, so it could be black and white, right? But in trading, you have gray areas. Okay, in trading, you have gray areas. Okay, then in a conventional mindset, failure is not acceptable. Failure is not acceptable. But in a trading mindset, failure is part of growing. They say a smart person doesn't fail, meaning you don't lose a trade. Okay, so you come with that mindset that, man, it's not possible for me to lose this trade. I must make a profit on this trade. No, it doesn't work that way. In trading, losing is part of the game. You need to come to a point where you take losing, okay, like part of the school fees that you pay to learn the process. Just like in your conventional businesses, you need a capital to run your business. So losing, okay, is part of the capital that you need to pay for revenue generation. Okay, then there's, in the conventional mindset, there is certainty. In other words, 1 + 1 is 2. Okay, if I see X, then I must see Y following. But in trading is different. There is a lot of uncertainty in trading. Okay, so you need to have that dynamism, create room for that uncertainty. Okay, now in the conventional mindset, we have standard procedures versus probable outcomes. In other words, conventional mindset, this is how it must be. Okay, in trading, it's not always the case, but we have a higher probability of it being the case. Okay, so now moving on to the next slide. Okay, the trading mindset is a mindset of probability. In other words, if I see a trading opportunity, there is a probability that this trading opportunity might actually give me a profit or might result in a loss. So the earlier you get used to that fact, the better for you in trading. So many people call themselves risk takers, but the truth is they cannot really take a risk. Now, how do I mean? For those of us that are new to trading, and for those of us that have been trading for a while, when you put up a trade, okay, the question you're asking yourself is, if I take a loss on this trade, how does it affect my psychology? So if picking a trade and you're taking a loss and it doesn't affect your psychology, then it means you have taken up that risk that in case this doesn't work, I'm ready to lose X amount of funds. So if all you do when you put up a trade is like you're looking out for profits, then sorry, you need to go back to your drawing board. I saw someone asking a question on the chat box. Okay, something relating to how do I know when to take how do I control my emotions? Okay, when I put on a trade, it's very straightforward. Okay, you have to have the right mindset. The only way you can control your emotions is when you are ready for the loss if it doesn't work. And that is why your strategy must be a high probability trade strategy. Okay, I'm going to go back to when Henry was answering one of the questions that was asked. And that question was, how long do I have to back test my strategy? And he said something, okay, you keep testing your strategy until you know that that strategy is bringing out consistent results. And he said, if it takes a year, then keep testing the strategy. Amazing. But guess what? Many people don't want to put in that work. But shockingly, that's the only way that will give you confidence in your trading strategy. Because until you have proven your trading strategy, okay, that this strategy has a higher probability winning ratio, winning rate, then trust me, you don't want to adopt that strategy on your live account. You don't want to go live with that strategy because you've not tested it. So it's not trusted. Okay, so you need to understand the right mindset for trading. And that right mindset is, I've tested my strategy. I realize that my strategy works so well, so I can trust my strategy. So even if I take a loss on this strategy, it doesn't affect my overall trading psychology. Okay, so now let's quickly answer the question, what is probability? Now, probability is the extent to which an event is likely to occur. In trading, there are only two likely outcomes. One, losing. Two, winning. Okay. So the question now is this. When you are putting up a trade, to what probability level, okay, is that trade likely to be a winner? That should be the benchmark for your trading strategy. If my trading strategy, okay, can give me at least a 60% winning ratio, okay, then that trading strategy is a good strategy. But of course, the more the merrier. So a 60 to 70 to 80% winning ratio, trust me, is amazing. And if you have a 90% winning ratio, man, you're out of this world. Okay, so the second definition says the extent to which something is likely to happen or be the case. Now, guess what? In trading, because you have only two likely outcomes, it's the more reason why trading should actually be much more easier. But you see, the problem is this, because it has to do with our funds, and we have not really taken our time to test our strategy to realize that this strategy has a higher probability winning ratio, okay, it affects our trading psychology all of a sudden when we start having a losing streak. Because guess what? Losses will come. The question is, are you ready for the losses when they come? Okay, so I move on to the next slide. But before I go there, okay, I have a note in red. Whenever you are unsure about the outcome of an event, we can talk about the probabilities of certain outcome or a certain outcome. Now, let me take that again. Whenever you are unsure about the outcome of an event, in other words, there is no certainty, okay, then you can talk about the probability of certain outcomes or a certain outcome. Now, what that means is this. In trading, we are not 100% sure. So we speak in terms of probability. So in a nutshell, what we are trying to say is this. Always make sure that your strategy has a high probability winning ratio. Now, the successful trading mindset. Now you can see this guy, because he has a successful trading mindset. In other words, the trading mindset of a successful trader, he's confident, and then his results are skyrocketed. What then is a successful trading mindset? Number one, a successful trader is open to losses. He embraces losses because he understands that it's part of winning. A successful trader realizes that it's a game of numbers. In other words, it is probability based. A successful trader understands that nothing is cast in stone. In other words, it's a 50-50 outcome. What do I mean when I say 50-50 outcome? I'm not talking about the probability ratio of your strategy now, but I'm saying even after putting on a trade that has a probability, high probability of winning, okay, for example, now I have a trading strategy that has an 80% probability of winning. There is still a 20% chance that I will take a loss. Okay, let me use an example that most of us might be used to. Now they say we should always practice safe sex. Now, when they talk about practicing safe sex, they'll tell you use a condom. But guess what? Even the condom, they don't tell you that it's 100% foolproof. They tell you it's a 99.9%. Now, why are they saying 99.9%? Because there is a 0.1 chance of a lady getting pregnant. What does that mean? Yes, the chances are very slim. Nevertheless, there is a possibility. So we are saying the same thing, bringing that ideology or bringing that analogy into trading. Okay, 70% winning ratio means I have a 30% chance of still taking a loss. So that's what I mean by when I say nothing is cast in stone. There is a 50-50 outcome. Now, we need to trust the system, not the strategy. What do I mean when I say trust the system, not the strategy? Now, strategy is not just system, rather, it's not just about your strategy, or trading is not just about your strategy. Everybody has a strategy, but system is deeper than that. Okay, system has to do with your trading psychology. System has to do with your strategy. System has to do with your trading money, your money management strategy. Okay, system has to do with your risk exposure. Okay, the risk that I'm willing to take on my capital overall. Okay, so you need to trust the system, not just the strategy. Okay, in other words, rather, okay, at times your system might tell you, oh, my strategy works best on only one particular pair. So you need to stick with your system, not the strategy. Okay, because I, for one, used to believe I could trade multiple pairs all at once, but I came to realize that my system only allows me to trade some certain pairs at once. So right now, I don't trade more than 3 pairs at once. Okay, in fact, not at once. I track those 3 pairs, and if I see trading opportunities on them, I pick a trade. Now, I don't do more than 3 pairs. Now, the lady that was supposed to take this session, okay, she doesn't do more than 1 pair, and she's an amazing, successful trader. Okay, this lady makes as much as $50,000 on a trade. So for you to understand her pedigree, what that means, yet she trades just only 1 pair. So what am I saying in a nutshell? Don't be a jack of all trades and a master at none. Okay, be focused. Now, winning, moving on to the next thing, winning is about the mindset, not the strategy. Winning is about the mindset, not the strategy. You can have a strategy that has an 80% chance of winning, but if you have the wrong mindsets, it's still the same thing as having a strategy that has a 0 probability of winning. How do I mean? With the right mindsets, even when you take up losses, okay, you will still be confident to put on another trade. With the right mindsets, even when price gets, I don't know, for those that have been trading, you can relate with this. You put up a trade, it goes 1% almost to your TP, and then it reverses back and takes out your stop loss. Meanwhile, your analysis is right, meaning that trade could succeed. But because you're not, the psychology of almost taking profit and then you take a loss eventually, you're not confident enough to put on a trade again. Okay, so at that point, you give up. So that's why winning is about the mindset, not the strategy. So you need to have the right mindset. I put up a trade yesterday on crude oil. I wasn't on sit and it didn't get close. It got very close to my TP. I think about 20 pips away from my TP and then it reversed. I had over 200 pips, on that trade. And then it reversed back to my entry point, almost taking out my stop loss. I'm still in that trade, okay, because there are two possible outcomes of every trade. Either it hits the SL or it plays out. Either it hits the SL or it works out. So we need to develop the right mindset. Ordinarily, I got upset. That's emotions at play now. I got angry. Why didn't you? I mean, come on. You just lost this beautiful opportunity. Okay. But nevertheless, I needed to revert back to my system. And the system says, stick with the system. Stick with it. Okay. So winning is about the mindset, not the strategy. Now, a successful trader understands his ability to adjust to the mindset, to the dynamism of the market. The market is very dynamic, so you need to learn to adjust to the market. You need to learn to adjust to the markets. Okay, you need to learn to adjust to the market. In other words, when losing streaks come, how do you react? Okay, a successful trader is open to change. He's not fixated. How do I mean? You need to know when your strategy stops working on a particular pair. I used to have like a 90% winning ratio on gold, but later I realized that, oh, my strategy is no longer working on gold like it used to. That's reduced to like about 30%. So I needed to cut down on the number of trades that I take on gold because of that. Okay. The winning mindset, you need to learn to take breaks regularly. How do I mean? Your mental composure is your greatest asset. You need to protect it. Learn to protect it. Okay. Now, it's not a crime to take breaks from the market when you realize that your mindset is not you're not thinking straight. Let me use that word. If you find out that you're not thinking straight, if you find out that you're bothered, if you find out that something is disturbing you, you don't have to be in the markets. You're going to take a wrong trading decision. Okay, you need to have a very fresh mindset, fresh approach anytime you're coming to the market. So your mental composure is your great asset. The moment you have disturbed, take a break from the market. Very important. Okay. Then successful trading mindset, they are open to learning. Successful traders are open to learning. Okay, don't think you are the Jagaban of the Forex market. Okay, you need to learn to be open to learning. I've had meetings with the best traders, and I realized that yes, this best of the best traders, yes, they're open to learning. Now, trust me, by the time you're able to develop this mindset, you just be like this guy in my slide. You finally nailed it. Okay, you have become that fantastic trader, and trading becomes easy peasy. Okay, so you need to understand that mindset, stick with the right mindset, and do the right thing. When you find out that you're having a losing streak, take a break from the market. There's nothing wrong with your strategy. No, the market just decided to behave that way at that time. I mean, take a break, okay, from the market, take some days off, a week off, 2 weeks off, and then come back with a fresh mindset to the market. So for the fact you're taking losses doesn't mean you're a terrible trader. It's part of the game. It's part of the business. Okay. So at this juncture, I come to an end of this presentation. Now, at IBF Markets, we have concise trainings to equip you for a successful trading career. The head of training has already said some things already about that. Now, one of the things we pride ourselves in is when it comes to fundamental and technical analysis training, we got you covered. Some people want to understand how fundamental analysis work. Okay, we got you covered in IBF Markets. Yes. So with that, I want to hand over to the head of training to take it up from here. Thank you very much for listening. Thank you very much for your patience and your time. God bless you all.
Okay, thank you, Mr. Chooks. Thank you, thank you. That was a very, very, very good session. And if we have any question that we need to ask, let's drop it on the chat box so that they can attend to it in 5 minutes. We are rounding up very soon, very, very soon. We're rounding up. Please don't forget, we run 50% bonus for everyone that joined this webinar, 50% deposit bonus. And I would like everyone to take advantage of it. And the moment you have the bonus, we are adding you up to our free signal group for everyone where you can take trades and make money for yourself. Okay, do we have any question? All right, in the absence of no question, I would call on Mr. Chooks to round up the webinar. Thank you.
Okay, thank you guys once again. Want to appreciate all of you for attending this webinar. Okay, like I told you guys from the very beginning, it's Financial Markets Expo. Okay, I want to use the word enough is enough of all this wrong perception, wrong information flying out there, okay, about the markets. Okay, it's high time we all get educated, get to understand the right way to approach the markets so that we can turn out consistently profitable. Okay, I'm sure that this has been an expose, and your eyes have been open to a lot of things about the markets. All the speakers happens to be on one page, even though we did not all agree that this is what we're going to say, but somehow, because we're all experienced traders, we've seen the highs and lows in this market. Okay, so we've come to understand what works, and that is why we found ourselves saying relatively the same thing. Now, we cannot overemphasize the importance of the right education. Okay, and that's why at IBF Markets we offer quality education, okay, to people out there. Okay, we want to sensitize the public on how this market rightly works. Okay, so with that, I give a vote of thanks to all of you for attending, to Idowu Adekombi, Hendrik Invest, to Bumi Odekunle, to the moderators, and to all of you that attended. Thank you very much. For Nigerians, happy Independence Day. And I hope that this webinar has done due justice to make you guys financially independent. Okay, so we look forward to working with you guys and to assisting you guys. So thank you very much and enjoy the rest of your holiday. Thank you.